Excuse me. 2019.
Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 4th of March. It's 10:30 in the UAE, and we have Brent crude oil up again this morning, 2.5%, trading at 83.39 on Brent, and that's the sort of third day in a row. Of course, we've seen a climb in the price. The issues have sort of varied. The stress of that the oil price can indicate certainly was quite a significant day yesterday, with a lot of developments that we might want to chew over in this podcast. Let's kick off in London and start with our regular commentator, Malia Bengali, founder of MB Commodity Corner. Malia, your thoughts on the price of Brent, if you like, reflecting the appropriate risk. We saw yesterday that Trump jumped in towards the end of the day and calmed the markets down a bit with this commitment to provide the insurance and the protection shipping would need to come into the Gulf. Is that a game changer?
Thank you, Sean, for having me on. Absolutely. It could be a game changer, but I think what happened later, a few hours, was the US Navy actually came back saying that the escort was not possible. I think in theory, that seems like a credible plan, and I think France is talking about that as well. But in reality, how they're going to actually achieve that is going to be yet be seen. If they manage to get the flow of oil leaving the Strait, because that's the biggest problem. Like, there's a lot of oil stuck in storage with Saudi Aramco and Iraq. But if they manage to get that done, it could get the oil prices down, because there's a lot of risk premium in the price right now. The oil actually is just stopped because the Strait is allowing China to use its ships to transport the oil. So the oil hasn't stopped. The question is, how fast can you actually do it? We don't know. The Navy is saying this insurance is not possible. And there's a lot of attacks still going on between Israeli raiders and US raiders. So it's a bit hard to say. But if that happens, yes, it will actually ease the concerns of oil.
Let's go across to America, deep in the West. Brian Pieri, founder of Energy Rogue in Denver. Brian, the view from the US, it seems the equity markets are fairly calm, the oil markets are fairly calm. In the past, we've seen particularly the equity markets having some sort of ability to curtail Trump's sort of, I don't know, worst instincts, but nonetheless, it doesn't seem that they're too stressed out about this. What's you think, the perspective from the US at this point, 5 days into this war?
I think, and thank you for having me on, and piggybacking off of something Malia said, that the intent of the U.S. escorts is intent is easy, execution is hard. So when we're talking about calming the fears on the oil markets, that gets to be a factor. But when you look at the viewpoint from the U.S., there is a muted effect, because there's not I mean, obviously you're in Dubai, and you are living and breathing this every single day. People in North America are not seeing that. They're not seeing that experience. They're not living that experience. But one of the things that is impacted is that people are very aware that this will have an inflationary impact, and the linkage from 2022, when Russia invaded Ukraine, that is in recent memory, to where when oil prices go up, this is gonna hurt. We don't see it day to day. Like, I looked at flight prices last week versus this week. They're up maybe 10 to 20%, because I was looking at a flight, and gasoline prices are up probably 5 to 10%. So we haven't seen spikes yet, but inflation is definitely on people's minds. When we look at the equity market, I kind of mute that with there's so much distortion with the AI stocks and the tech stocks that really just don't detach it from reality. In my perspective, it doesn't really. S&P 500 goes up, it's like, whatever. It doesn't really impact anybody, because it only impacts 7 core stocks, and that's not going to help Main Street. So I'd say the impact in the United States is somewhat muted right now, but there is a public awareness that this is going to have a very inflationary impact. How long? I don't know. Well, the U.S. citizen doesn't know. If you look at the futures curve, it's
But nonetheless,
isolated.
there's no curtailing pressure coming on the Trump administration on this action. Congress is relatively impotent. Wall Street isn't really signaling to Washington that they need to change course.
There are a few pushes. There's probably about, from some recent polling, which one poll to another, you're going to get a different answer, but some recent polling had a 30% approval for this action and 45% disapproval of this action. So I don't think it's in a very popular stance. There's a lot more caution around this, as much as why are we doing this? Plus, there's questions about whether or not Congress should have been engaged before the fact. And that is a big core question because, by contrast, the recent contrast period is probably going back to Iraq, and George W. Bush obviously lobbied for the invasion in Iraq, but we're going back a long time, and those were different times. And now, is that the right move or whatnot? There's a lot of question marks, and I think
Sure.
the public favor is probably no.
Let's go to China. Liao Na, Chief Consultant and founder of GL Consulting. Liao, thank you for joining us. I wanted to start with getting your insights on the immediate impact on flows for China. Of course, the blocking or the Strait of Hormuz being a block on flows of oil and gas coming out of the Gulf. Most of that turns left and goes to Asia, and a lot of it goes to China. What immediate or sort of medium-term impact does the closure or the disruption of the Strait of Hormuz have for China?
Okay, thank you, Sean, and thank you to have me on. And yes, it's I think China is also the whole Asia is the big hub of all these Gulf resources, including oil and gas. And look, this a short answer is China has a strategy mode for the next few weeks, but we are looking at a massive supply chain cliff come April if this blockage hopes. And let's break down the modes first. As we speak, China is sitting on a very quite comfortable cushion, and our LNG terminals inventory are up to about 9% year on year. And we are talking nearly 6.7 million tons in the tanks, and that's a solid 3 to 4 weeks buffer. And couple that with the fact that we are in a seasonal sweet spot. Demand is naturally low as we're moving out from the winter, and you also realize Beijing isn't pushing the panic button just yet. And just notice that today is the starting date of China's two-session the summit meeting, and actually this is not in the discussion topic, but China have a quite strategic measures over that.
So in the immediate term, China has built a huge storage of oil over the last 2 years, maybe 100 plus days of cover. China imports 12, 13 million barrels of oil a day. It has at least 100 days, if not more, of import cover. So there's no stress on China's current stockpile. And usually at times like this, China, when prices are high, whatever the reason, China would draw from inventories rather than buy expensive oil. But what if this drags on a little bit? The Strait of Hormuz stays closed. Iran looks quite determined to keep the flow of oil and gas out of the Gulf blocked. If this goes on for a few weeks, is this a problem for China?
Okay, and that's a good question. And first of all, I would like to highlight or bring another angle about China's inventory, like especially for the crude inventory. Since you said, and actually that's the most said in the market that China's inventory can support to 120 days. But from our data, I would like to say that's much more than that. We just take the accumulation of inventory since the start of SPR in year 2008, and the old surplus from inventory annual will add on until last year, 2025. The total volume already exceeds 530 million tons. And in volume of the consumption level of last year, 2025, that will equivalent to 240 days. That's almost 8 months. So that's a more wide range, broader definition of inventory rather than the strict definition as SPR, because in the China new energy law launched in year 2024, which already expand the inventory, the so-called strategy reserve, to a much wider territory, even including enterprises and those long-term suppliers and floating. So currently, I believe the China's crude inventory is quite comfortable. And
So you
more
say,
than
sorry,
100
just I
days.
get you said 240 days of import cover. Is that what you said?
Consumption.
240 days of consumption, not just not just imports, but consumption, which is about
Consumption.
15, 16 million barrels a day. That's quite a lot of storage. Perhaps, Maliha, that's why the oil markets are relatively calm. We saw after the Russia's invasion of Ukraine, of course, oil spiked well above $100. On this occasion, it's been relatively muted. And we have not even yet seen strategic petroleum releases announced from Europe, OECD, or IEA countries, or US. Do you expect that to come?
You're absolutely right. I think the market is confusing between actual outage and just delays, right? We haven't seen any loss of barrels yet. It's just a supply rerouting. In the Russian-Ukraine war, the market completely exaggerated that we lost 10 million barrels per day, which we did not. And I think people are calling for $100 oil, $200 oil, really don't understand how the oil market works, because if you look at the demand supply and the balance, we have a lot more spare capacity. So it's just about the rerouting. So no, we expect, I mean, it's hard to say, but if the war sort of subsides in the next few days to a week, eventually there's a lot of pressure from the Gulf states to America right now, because this is getting way out of hand. And I think all the people are actually coercing the US to end this war at some point. I think Trump himself, like you've seen him, all his trade tariffs, every time the macro system gets stressed, whereas US bond yields or the US financial system or energy prices, he pulls back. So the question is this going to be another taco when he sort of comes back, right? But we don't see a risk to oil prices because supply is ample, and OPEC has already increased production. I think double the amount they want.
But Maliha, we have seen, the announcements yesterday from Iraq that they're having to start to shut in production.
Correct.
Qatar Energy has already announced that they've shut in their LNG production, which is a massive global 20% relevance. Now Iraq, the first big oil producer in the region, to announce it's going to have to shut in production because they've nowhere to put the oil.
Yeah,
And
you're right.
that could amount over 2 or 3 weeks to 3 million barrels a day. Kuwait have signaled the same. They have nowhere to put the oil. They're going to have to shut in production. You could end up in 2 weeks with 6, 7, 8 million barrels of oil shut in.
So you're right. The shut-ins are come to right now about 1.2 for Iraq right now. That should have been shut in. Take a look at the two oil fields. Gas is very different, Sean, because LNG is about 20%, is 77 million tons comes from Qatar. You've seen UK gas prices, EU gas prices up 100%. We were trading 60 euros per megawatt hour. Just to put it in perspective, back in the Russian war, it's trading at 300 euros per megawatt hour. So yes, it's an issue because Europe is short on storage. Gas is not oil. So it's very different markets. But from the oil perspective, you are correct. Iraq is, wells are not shutting in. And the question is, how long does that say shut in for? More than a couple of weeks, it'll be an issue. Absolutely, because the wells will need to be closed. So it's very hard to say, but there's no, like I said, there's no shortage of oil. It's about this flow of oil. And China, like as she mentioned.
Of course, there's no shortage right now. Ultimately, we're not talking about, oil delivered this afternoon. Oil is traded as a future commodity, obviously, and sort of looking towards where this is going. Brian, just to come in on that, I mean, oil pricing the flat month, the out months, remains rather sober given what's at stake here. Is the oil market still underpricing the risk?
That's a great question. And if you look at the price risk, if you look at the forward curve, and just piggybacking off what Malia said, when you look at the LNG prices, there's been a dramatic, very quick response. Last week, they were about $10 to $11 per MMBTU, and they're now upwards closer to 20. So they've shot up pretty quick, but by contrast, not as much as 2022. Now, if we look at crude oil prices, most of the price escalation has been contained to 2026 pricing. If you look at 2027, Brent is still below 70. It's in the high 60s, and you look at WTI and it's in the low 60s. So the forward market is really pricing in where crude traders have been over the last 3 years after absorbing the Russia invasion in Ukraine, where there was a lot of price shocks. Now oil traders have been in this, show me the disruption and then I'll respond. And they're showing the response in the front 6 months, but it's still somewhat muted, mainly because, to Malia's point, there hasn't really been a disruption yet. It's just been sitting in ships. But if you pile this up another week, if we circle up in another week, we're going to have a different problem. So that's what I think.
Liao, I wanted to get your views on the bigger picture here, the sort of 10,000-foot view, strategic. The Trump and Xi Jinping are meeting in China in a few weeks' time, and it seems to me no coincidence as to why Trump said the other day that this war would last 4 weeks, because it essentially seems to me planned to stop or end before the summit with Xi Jinping. But the outcome of these events in both Venezuela and now Iran would appear that the US and its allies, if you want, are taking full control of the energy resource, the Venezuela and Iran, but obviously they already have a big overview of the other Gulf oil producers, that strategically they're taking Venezuela and Iran away from China, curtailing the oil supply to China. I'm wondering, from a Chinese perspective, how do you view these developments in Venezuela and now Iran, which were both supplying a significant amount of oil to China?
Yeah, that's a very good question, and we also discussed this in London's forum, right? And just as a follow-up on the Venezuela and Iran comes next, comes as next. So first of all, China identified as 3 challenges, and actually, that's already within Beijing's expectation since last year. Why? Because in U.S. strategy reports, it already put China in the strategy competitor's position. And all the after Venezuela, and we identify grouping the challenges or the competition way from 3 ways. One is resources control. That's including all these upstream supplies, including oil and gas, and also other mineral supply as well. And the second is the role, the Navy role. And the third is the currency. All these are targeting, aiming on China. And how to counter with that? China actually already built its more systematic and gradual long-term measures, counterpart measures. Resources dynamic, including looking ways to expanding the Central Asia pipeline and some within the railway and some road transportation, and that will be one of the resources. And also supply, like China and Canada's relationship is getting warmer, and Canada can be a quite good alternative either for Venezuela, especially for the oil sand from Canada. That's one of the good choice, and also gas as well. And for the Navy role, and China is building, we think that the straits somehow comparatively will be friendly to China's ship. And also China have its military equipments to some container already. So that's the how to protect the transportation in the sea road and from the currency one. And also we're trying to expanding the currency RMB settlements with other Middle East countries, including Iraq. And we're also seeing a report saying that Iraq already start to accept RMB settlement, RMB as a currency settlements in commodity and in other trading settlement as well.
Do
So
you think
China is still keep expanding.
Do you think China, I mean, we heard, as I said at the beginning of the commentary, that most of the oil and gas coming out of the Gulf goes east. It used to in the decades before go west, but now it all goes to the east, and China being the biggest customer. And yet it is America that is paying for and providing the security of the shipping lanes so that China gets its oil and gas. Is there any indication that China would be willing or sees a need to provide security of supply?
You mean to secure China's fleet?
That China provides that China, like China's been very quiet in the last few days, given that they are the biggest, potentially India, but also China. Yes, you have a lot of oil and gas in storage, but ultimately supply from the Gulf is critically important. And yet China doesn't provide any security for the shipping channels. They're not protecting the shipping channels. They don't have any plan to protect the shipping channels. Do you think that could change? That China...
Right, yeah, and that's also one of the questions I received from my U.S. friends, which also from ExxonMobil. They just asked, when will China's Navy come to the Gulf? So I think I cannot respond as a foreign minister, but just from the Chinese culture. Normally, China will provide the support based on demand, only based on demand. And if you ask for that, China, we try to see how we can co-work with each other. But currently, China's Navy, all this infrastructure, we secure her own fleet first. That's the priority. And China currently, since last year, I believe you also read some of the reports saying that a lot of container already carrying missile in the container already. So that's one of the way how China will protect its his own fleets at the moment. And if someone else will need, that will based on demand. So that's a short answer to that. But China is not pursuing to expanding its coverage or take the initiative or aggressive approach to show so-called power, military power so far. And that's not under current Beijing. I think just from my point of view, it's not Beijing's.
Yeah, of course. Yeah.
Sean, can I just quickly jump in here?
Please.
I have a question. If 90% of exports of Iran goes to China and China is the biggest importer, Iran has no incentive to stop the flow of Chinese oil. And I think that's what China's already maintained, that their flow will not be stopped. So what are we arguing about? But also, we also have another east-west pipeline that can go oil the other way, called the SUMED pipeline from the Suez Canal, and the EastMed pipeline has 7 million barrels per day of capacity. So I think we're arguing different things, right? China is the biggest benefiter, and they're not panicking because Iran will never curtail that relationship with China. And the rest of the Western oil will go through other pipelines, which is why we keep saying there's no shortage of oil and oil is moving. So the stoppings of Iraq are being met by other pipeline alternatives. It just may get delayed, but China is not in any sort of constraint here. They are very close to Iran and they're helping Iran. So I don't think Iran has an issue with that. That's my personal view.
Okay, let's go to the survey question, which is Trump's commitment to reopen the Straits of Hormuz is a game changer for oil markets. Agree or disagree? We don't see that game changer, I would say, while the oil markets are relatively calm, given the fact that there is a major war going on in the oil and gas producing center of the world. Nonetheless, the oil markets are not returning to their $60 oil 60s that they were sitting in before all of this started. The most forecast for the year was that a $60 Brent average would be the price. We're still seeing oil prices rise. So perhaps that tells us that the market doesn't see it as a game changer, and we will see. So I welcome your views on that. Malia, the wider markets, obviously we're coming into the stress of this following through, and there seemed to be a moment yesterday that the equity markets and the financial markets as a whole, including oil, started to price in that this conflict was going to drag on and was going to have the sort of knock-on effects. By the end of the day, it seemed that the market was acting that, no, this is still a short cycle impact. Where do you think the markets are going to traject over the course of the week, and should adopt that this will or will not be a sort of longer term impact?
So if you see the actual market and the US economy, I know nobody wants to talk about fundamentals, but the US economic data is coming out very positive. The US manufacturing data came up higher, has good implications for the ISM and PMI. The earnings that are coming up from Q4 and Q1 have actually, numbers are going up. So the S&P has a lot of support here in terms of forward earnings, especially with the rest of the remaining members outside the Mag 7. The question is, obviously, if this conflict becomes a massive recession, all bets are off, right? But right now, the US economy is actually, the data is very, very positive. If this war wasn't going to happen, we could see S&P north of 7,000, 7,100 easily. So I think that's what the equity market is being a lot more sanguine about this conflict, because sadly enough, wars are when people buy markets, and I think everybody's knowing that that's what's going to happen. So we're not really bearish on equity markets. The Kospi in the Asian markets, you've seen there's a massive correction in South Korea right now. The market's down 10%, but they were very inflated and they're very dependent on oil. So there's specific pockets of weakness, but from a general
I mean, there's nothing more inflated than the Western markets. I mean, Washington, New York, and all of its, P ratios averaging up at 30.
Yeah, but the earnings are there to support it. This is unlike the dot-com bubble. The earnings have kept up with the PE multiples.
No, PE ratio is 30. That's not earnings. That's double the average it was a decade ago.
Right,
I mean,
but look at the
you're saying earnings are there to support it if indeed you take 30 times earnings as normal.
But take a look at some of the earnings coming out right now. The gap between the earnings ratios and how much, look at NVIDIA's numbers, it tell you everything. We have margins of 70%. So they're not really going up a lot, but they're still very positive earnings. There's a lot of cash. The issue, the Mag 7, is that they're getting free cash flow negative. But the remaining 493 names are seeing an uptick in earnings and uptick in margins. That's where the market is pretty much flatlining, right? You're seeing a rotation. So the market will be borrowing on the index level, but there's a lot of subsector rotation that's actually helping equity markets in general. Plus, you forget there's a lot of liquidity in the system. Financial conditions are very, very accommodating right now with interest rates and central bank policy, fiscal stimulus. So if you take the war out, markets were on a very sort of a positive swing. So, and then you have the main thing we are concerned about is the dollar. People are very short the dollar, and the dollar has been going up because of this conflict, and that's seeing a sell-off in commodity markets, right? Because people are very bearish the dollar. So we have to keep an eye on positioning in some asset markets. But the bond yields are contained. 4.1% for the US 10-year is not a concern. Oil prices, if it stays on 80, is not a concern. But, we have obviously concerns in the gas market because that's a much more EU problem. So I think there's specific areas of stress, but on the general, from an economic point of view, no, not yet.
Brian, if you might just wrap us up with some updates on where the U.S. oil production may go. I mean, at the end of the day, whatever the reasons, we have $80 oil, it's still $80. And this is a good level for U.S. majors to put money in the ground in the Permian, more into Guyana, maybe even into Venezuela. Where do you think the Americas goes with this $80?
The US is probably going to be mostly flat, maybe grow a little bit. We've been on that trajectory for the last couple of years where we jumped up to 13.2 million barrels a day, I think a couple of years ago, and we're up to 13.7, 13.8. So we've just been kind of grinding up little by little. I do think when we look at higher prices, with the consolidation that we've seen in the U.S. Permian, as well as across the U.S. infrastructure on the upstream side of things, I think a lot of the investment dollars are going to go to different types of investments, maybe even infrastructure across the Middle East. That might even be some of the infrastructure building pipelines across to get alternative routes rather than going through the Strait of Hormuz. So I can see some pivots to more midstream type activity versus upstream activity. So I don't see a lot of growth in that, with the exception of Guyana is going to have a little bit. Venezuela is probably not. You're not going to see much in the next 12 to 24 months.
But maybe you'll see in the interim money actually put to work rather than oil come out of the ground.
Right.
Leo, let's just get the survey result and get the last word from you. So disagree, Trump's commitment is a game changer, 2-1, disagree. That's, I suppose, being reflected in the price. Leo, I wanted to get your thoughts again, putting aside all the reasons why oil is $80 a barrel, just from a point of view of imports into China. Do you expect China coming out of the New Year holiday to continue to buy a lot of oil, or at these prices they may pull back?
Okay. Yeah, and a short answer is, as we said, China currently have a quite comfortable mode in the inventory. So China is not rushed to buy. And normally China's the comfortable inventory buys price will be 60. And if there's a warning line, I think if crude price go above 90 and stay a longer time, I think that will be a warning line for Beijing to step in and to start engagement and interference with the region. And more important is from an economic standpoint, we are not just looking at a regional war. We are looking at a massive supply chain, supply side shock that act as a twin pincer attack on China's export. So I think that will be the angle we more look into. That will be the cost corridors and the global stagflation. And because China is the world biggest export company, as we already seen last year, China is a manufacturing titan that breathes energies and petrochemicals. So when oil and gas spike, the entire value chain, we feel this. And take methanol as a prime example. Iran supplied nearly 60% of China's methanol imports. And if that tap close, it doesn't just hurt a few traders. It will triple through the MTO plants in East China and drive up the cost of everything from the plastics to synthetic fibers. So when we saw the raw materials and power bills goes up, then FOB and the global, I think the FOB price we have to follow. And in a hyper competitive global markets, and even the 2 or 3 price hike can test the price elasticities on these Chinese goods. So suddenly that made in China price advantage start to evaporate. And remember, as OECD points out, every $10 jump in oil price on around 0.5% to global inflation. That leads to a higher interest rates in Europe and that in US as well, which essentially cool down the every consumer's China's rely on and also hurt the economy there. I think that will be a global issue, and it's a more classic stagflationary trap. So I think
it seems that we do need to go that if one considers that $60 Brent was the kind of average price for the year before this crisis started, and we're now close to 85, then that's $25 of geopolitical risk premium, $25 of inflationary efforts. It seems to me that this event is obviously happening a few weeks before Trump and Xi Jinping will meet in China. And if indeed Trump has your 60% methanol in his pocket before he goes to Beijing, that will give him some leverage at that negotiating table, which I think, you know, a lot of this is about. Anyway, that's just a side takeaway. Brian Pieri in Colorado, thank you so much. Leo Na in Beijing, thank you so much. And Maliha Bengali in London, thank you so much. All around the world in 30 minutes. No other podcast does it. Thank you, guys. Talk to you all soon.
Thank you,
Stay
Sean.
safe.
Thank you. Bye.